Hello and welcome to this Accounting 2208 Chapter 15 video lecture on accounting for errors related to shareholders' equity. This video will review accounting for error analysis using extra problems 15, 4, and 5, which correspond to JL Corp and McLP. So let's get right to it. With EP 15.4 JL Corp, we've got here an audit of the books of the company recently conducted for the year ended December 31st, 2018. The company follows IFRS, and the shareholders' equity accounts at January 1st, 2018. So this would be at the beginning of the year, right? And December 31st would be the end of the year. We have some preferred shares that pay a $3 dividend. They're cumulative preferred shares. 10,000 authorized, 1,000 issued for an equity balance of 50,000. There's some common shares, unlimited authorized, 15,000 shares issued and outstanding with a carrying value of 101,250. There's contributed surplus relating to common shares. Contributed surplus results when the company reacquires its own shares and pays less than they received initially when they issued the shares. So if the company issues shares at $10 and then decides to buy them back at $5, it has a, use the term loosely, a gain. You can't have a gain on your own shares, so that difference goes to contributed surplus, in case you were wondering what that was. So the balance in contributed surplus is $37.50, and there's some retained earnings for $300,000. And in examining the books, the auditor discovered a whole bunch of items. So we'll go through each of those items one by one and identify the error or errors involved and determine what correction, if necessary, is required. Okay, so for the first error, in November 2017, that's a prior year, legal fees of $6,300 were settled by issuing 700 common shares. The bookkeeper debited prepaid expenses and credited common shares. So something is not right with that situation. So what happened is, right, those legal fees should have been expensed in 2017 rather than recognized as a prepaid asset, right? Putting it as a prepaid asset means that the amounts were prepaid. This wasn't prepaid. These legal fees were related to a lawsuit, and instead the company issued shares. And because it's 2017, this is the prior year, which means that it impacts retained earnings only, right? So there's no current year impact, right? So no error in 2018, prior year impact only. So here's a little table that you can use to help you to rationalize what happened. So they did nothing, and they should have expensed $6,300. Now the impact of not expensing $6,300 means that the expenses are too low, the net income as a result is too high, and if your income's too high, your retained earnings are too high. So to correct that error, we have to correct it in 2018 because we cannot go back into previous years and start mucking around. So because the company debited prepaid expenses, right, which is an asset, we have to reduce the prepaid expenses. So there's a credit to prepaid expenses for $6,300, and this expensing of the legal expense in the prior year, right, if we would have properly recorded the expense, we would have debited the expense. So we need to debit, right, but because we cannot debit the expense, right, because the year's closed, 2017 is closed, we have to debit retained earnings instead. So debit retained earnings, credit prepaid expenses, and this error is taken care of. Okay, for error number 2. JL Corp repurchased 2,500 common shares for $9 on January 3rd, 2018. So this happened in the current year. And they made the following journal entry. They debited common shares to reduce the shares, 16,875. They credited retained earnings for 5,625. They debited retained earnings for 5,625, and they credited cash for 22,500. So is this entry correct or not? Well, we need to double check here that this adjustment to retained earnings is accurate, because we know that the company repaid to purchase the shares, they paid $9, but what is the actual book value per share? Well, what happened here is they reacquired 2,500 shares at $9, right? Now, when the assigned value, also known as the book value, was $675. Now, we determined that $675 by looking at the balance sheet, the partial balance sheet we were provided. We saw that the carrying value of the common shares was 101,250, and there are 15,000 shares. So we divide them, so the average price is $675. Well, the company paid $9 versus $6.75. So they paid more, therefore paid more, right, than the average price. Well, normally, if there is no existing contributed surplus balance, then it would have been correct to put all of that to retained earnings. However, right, as we keep reading along here, when shares are repurchased at a price greater than the assigned value, share capital is debited, right, equal to the assigned value, and then contributed surplus is debited up to any previous balance. And then retained earnings is debited with the rest. So the problem with this one here is that January 1st, the company had a contributed surplus, right? A contributed surplus here. There was a balance of $37.50. Now, had they done this properly, right? Sometimes it's how you approach errors is really up to you. There are so many different ways to do it, which is why students hate it, because there's no one approach. So if the correct entry would have been done, right? This is not the correcting entry. This is just reviewing what the right entry would have been. They would have debited common shares for 2,500 shares, right, at the average book value of $675 for $16,875. They would have credited cash for the amount paid, 2,500 shares times 9, 22,500, no problem. Then, right, they would have then used up any existing contributed surplus balance. So they would need to debit contributed surplus for $37.50 and then credit retained earnings for $18.75, which is the excess. But you can see here what the company did is they put everything based on the entry up here. So in a situation where you know what the entry was and what the entry should have been, then you can make an adjustment. So here they've got the correct amount to common shares and the correct amount to cash, but the retained earnings gets $56.25, right? And that's because they combined the adjustment that should have been made to the contributed surplus balance and put it all to retained earnings. So now the nice thing about this as well, I'm just going to change the color here, is that when we see the entry they should have made down here and the entry they did make up here, we can compare them. So look, common shares got a debit of $16,875. Common shares should have received a debit of $16,875. So you know what? We don't need to make any adjustment for that. Cash received a credit of $22.5. Cash should have received a credit for $22.5. So the only items we need to adjust basically are contributed surplus and retained earnings. Contributed surplus for the full $37.50 and retained earnings for the full $37.50 to make up the difference. And here's what the correct entry then should be. We would debit contributed surplus for $3,750 and then simply plug the difference to retained earnings for $37.50. And based on the original transaction, if we would subtracted $37.50, you would end up with the correct amount of $18.75, right? So this one looks complicated, but is really fairly simple. Okay, now for error number 3. On March 31st, 2018, so in the current year, 10,000 common shares and 5,000 preferred shares were issued for total proceeds of $185,500. This is a lump sum purchase. At the time of the issue, the market values were $875 per common share and $52.50 for preferred share. Now what the bookkeeper did is recorded, right? Bookkeeper recorded entire proceeds to common shares. And there is of course no voting privilege for preferred shares. So there should be some allocation to preferred shares. That's what the error is here. So if you're familiar what should happen with share issues, this goes back to your prerequisite courses where we did share issues, I'm sure, when a lump sum share issues occurs, right, the total cash proceeds must be allocated between the classes of shares. So in this case, preferred shares and common shares, right, based on their respective value under the relative fair value method. So what does that mean? It means they should have conducted this type of allocation. This is very similar to the lump sum purchase of assets. I know that that's covered in introductory financial accounting. You buy a group of assets for a single price, like land and a building. Well, this is the same thing, except you have common and preferred shares. So what we have to do here is determine the relative fair value and allocate the sum accordingly. So what we know is that the company had 10,000 common shares with a value of 875 for a total of 87,500. The preferred shares, there are 5,000 at 52.50 for a total of 262,500. So the total value combined of all the shares is 350,000. And if we take 87,500 divided by 350,000, that's 25%. And of course, 262,500 divided by 35,000 is 75%. So we have to allocate this $185,000, right, 25% to common shares and 75% to preferred shares. So what should have happened is they would have credited common shares for 46,250 and credited preferred shares for 138,750, and the total adds up, and that's what they should receive for cash. But what happened was the company put the entire 185 to common shares. So all we have to do then is basically remove, so all this went to common shares, but that was wrong, right? So we have to only remove from that 185,000 the 138,750 that belongs to preferred shares. So we need to lower the common shares. We need to debit common shares for 138,750, and of course credit preferred shares for 138,750, and the error is all taken care of. All right, and now for the last error for JL Corp. So subscriptions for 2,500 common shares were issued on October 15th. This would be in the current year, by the way. And 1/3 of the subscription price of $12 was collected with the balance due in January. All right, so what they did is they debited cash and credited common shares for $10,000. Well, here's the problem. Under a subscription agreement, right, you do not issue the common shares until the issuing company receives the full subscription. So in the case here, there's still a balance due in 2019. So until the subscription is finalized, common shares cannot be adjusted. So it's incorrect to credit the common share account when there was a down payment received. That 1/3 is basically a down payment. In addition, an appropriate subscription receivable and associated common share subscribed account should have been set up. So this all relates to current year. There's no prior year adjustments. So in this year, what we can do is do the right thing and then fix the wrong thing. So the correcting entry in 2018 is, if we were to go back to the very beginning, right, when the share subscriptions were issued, the company would have debited subscriptions receivable for $12 times 2,500 for $30,000. And then they would be a credit to the common share subscribed account. This is a new account for share subscriptions you should be familiar with if you've reviewed share subscriptions already. So $30,000. Then what should have happened is that $10,000, right, would have gone to cash, this 1/3, right? So the debit to cash is correct, but what's wrong is that instead of adjusting common shares, that should have gone to subscriptions receivable. So what needs to happen here is, if the subscription receivable is set up here for $30,000 and then the down payment is received, so there needs to be a credit to the subscription receivable for $10,000. So credit subscriptions receivable, and then debit common shares for $10,000, because this $10,000 was the amount that was debited to common shares, right? Or sorry, that was originally credited to common shares, and that has to be removed. What you could have done here as well is, instead of debiting subscription receivable for $30,000 and then crediting for 10, you could have done a combination and only debited the subscription receivable for $20,000. So you'd have a $20,000 debit to subscription receivable, a $30,000 credit to common shares subscribed, and a $10,000 adjustment to common shares. And that takes care of that error, and that completes JL Corp. All right, now for extra problem 15.5, Mclp. So here, MC is a public accounting firm that performs audit engagements, and you're a senior auditor working on some client files, and during the past year, you've noticed some clients that are making errors with their shareholder equity transactions. So your objective is to summarize the errors and document the correct treatment, and 2, indicate the impact to the client's balance sheet. All right. And as usual, because we're in 2018, we'll assume the books are still open, so no adjustments can be made directly to accounts in 2017 for any prior year errors. Anything would have to go to retained earnings for anything that affects revenue and expenses. Okay, so for error A, or the first one of the clients, Ren Limited, had 540,000 common shares outstanding at November 30th, 2018. On December 15th, 2018, they declared a 6% stock dividend to be distributed in the next year, in January 2019. Now, at the time of the declaration, the company's or the common shares fair value is $15 a share, and the book value is $9 a share. And so they made the following entry. They debited dividend declared for 540,000 shares times 6% times $9 for $291,600, and they debited dividends payable for $291,600. So what did the company do wrong? Well, there's 2 errors here. First is that stock dividends are valued based on the market price per share, right? The market price, also known as the fair value per share, and the company used the assigned value or the book value per share, which is wrong. So that's the first error. So that's number 1, we could say. And then number 2, the other thing is that stock dividends are not payable in cash. And therefore, dividends payable is not the correct account because they're not payable, right? Anything that is to be paid in cash. So we have an incorrect account here, right? They should have done a share distributable account. And it's an equity account. So just showing what they've got here. So the correct value of the stock dividend would be 540,000 common shares. That's correct, 6%, but $15 instead of $9. So that adjustment should have a value of $486,000. The amount that was recorded was $291,600. So there's a difference missing here of $194,400. So what do we need to do to fix the error? All right, so in 2018, these are all current year. First thing we need to do is debit dividends payable because the company should not have credited dividends payable because that stock dividend is not to be paid in cash. So they need to remove that balance. So debit $291,600 to dividends payable, and instead credit the common share distributable account, which is what they should have done, right? So it's to be settled next year, it's to be distributable, and the common share, the dividend payable account, of course, is a liability account, but the distributable account is an equity account. Okay? So put that in the correct spot, and that's to reclass the dividend payable to an equity account. Then they would need to debit the dividends declared and credit the common share distributable account for the correct or for the difference to get to the correct amount, right? For $194,400. Alternatively, the company, because it's in the same year, could have done a reversal of the original transaction. So a full reversal of the $291,600 and then properly record the stock dividend at $486,000. Now remember, we were also asked to discuss the impact on the balance sheet. Those are the couple of impacts here. So the liabilities is reduced to reclassify the dividend to an equity account, which then results in equity going up, right? And then there is a net zero change to shareholders' equity. I think this is a little misleading because it's referring to this piece here. The dividend declared and the common share distributor are both equity accounts. So both equity accounts. So there's no they offset each other in terms of the impact on the equity. So there's a net zero change related to the second transaction, so a net zero change on second adjustment. Okay, because they offset each other. The stock dividend increases the quantity of shares outstanding, and the common share carrying value while reducing retained earnings through dividends, right? So the equity impact is a wash on this first transaction, but there actually is, in addition to liabilities reduced, the equity would increase, and that's related to here to the first adjustment. Okay, for the second error, B, a different client here, Soren, issued a press release declaring total cash dividends of $50,000 to all shareholders of record on October 31st, 2018. And that dividends to be paid on November 15th, 2018. Here's some balances in the ledger. They've got preferred shares non-cumulative, 50,000 authorized, 5,000 issued, with a balance of 625,000. Common shares, there are 40,000 issued, unlimited authorized, for a balance of $1 million. Now the preferred shareholders have not received dividends since 2016, right? And since Soren's year end is October 31st, right? The following, now this is a memorandum. It's actually not a journal entry per se. They made a memorandum here for the dividends are to be paid to preferred and common shareholders as follows. So they say that they should be paying a dividend of 5,000 shares times $3 times 2 years in arrears for a total of 30, and common shares would then get the difference, so that the total dividend is $50,000. But there's a couple of very important things here that you'll see in a minute. First of all, the whole reason why this information is given is so you notice that these preferred shares are non-cumulative. And what they did here is they, in their memorandum, they're planning to pay a dividend to the preferred shareholders for the arrears. But guess what? Non-cumulative preferred shares don't get dividends in arrears. So there are a couple of errors made, as I just discussed. Now the first error is basically that the dividends are actually to be recorded on the declaration date, right, which is before the year end. So on October 28th, they should have declared the dividend, right? Now, just because the dividend is declared doesn't mean it's paid on the same day. And so they only made a memo entry and plans to record the dividend when it's paid in the next fiscal year, right? So the problem here is that the liabilities in the equity accounts are not correct, right? If there's a dividend payable, the liabilities are too low. And because there should be a dividend, the equity accounts are too high. Now, that's entry or error number one. Error number two is that the preferred shares, as I said, are non-cumulative and not entitled to dividends in arrears. So the common shareholders should actually receive a higher portion of the $50,000 dividend. So the total dividend is $50,000, but the preferred shareholders should only get 5,000 shares times $3 times 1 year, not 2. So they should only get $15,000, and then the common shareholders would get the rest. So to fix it, we need to make an entry just prior to the end of the year to actually record the declaration of the dividends. So the company is going to debit dividends declared for $50,000 and allocate $15,000 to a dividend payable account for preferred shares for $15,000 and a dividend payable for common shares for $35,000, right? And that entry would be on October 28th, right? Then on November 15th, when they're paid, the cash would be debited and the payables would be, the cash would be credited and the payables would be debited and the dividend would be settled. So the balance sheet impact on this, of course, is the current liabilities will have to increase because of the promise to pay, and the shareholders' equity will decrease because the dividends are to be distributed to shareholders, and then so the dividends declared basically is an offset. It's a temporary account which gets close to retained earnings. All right, error C. This time a different client, Teddy, issues 8,000 shares for land. The asking price of the land is $156,000, but the value at the time is $150,000. And Teddy recorded the increase to land and the offset to common shares at $156,000. And the year end is December 31st, 2018. What did they do wrong here? Well, it's related to, the hint I'm going to give you, it's related to the value used. Shares in exchange for an asset are to be recorded at the asset's fair value, right? And an asset cannot be recognized at a value higher than its fair value. So just because the asking price of the land is $156,000, that's actually completely meaningless. The fair value is the number that's used. So instead of using 156, they use 150,000. So as a result, the land and the common shares account are both overstated by that $6,000 difference. Right? So the company is going to have to fix it. So the entry that would be done in 2018, because that's the year, is going to be a debit to common shares for $6,000 and a credit to land for $6,000. And of course, the impact on the balance sheet is that by debiting common shares, right, we'll be reducing equity, and by crediting land, we'll be reducing assets. So they're both reduced by the same amount, bringing the asset value down and the equity value down. But our balance sheet stays in balance, and that's it for this error. All right, for the last client, Jackson Limited, they issued 5,000 common shares in exchange for some equipment with a value of 150,000. And what they did is they debited repair and maintenance expense, and common shares got a credit for 150,000. And that equipment is expected to have a 5-year life and no residual value, and the company depreciates assets on a straight line basis. So what do you think the error is? Well, I'm going to give you a hint. It's related to this repair and maintenance expense. Of course, what should have happened is that equipment should have been capitalized, but instead it was expensed in error. So that means right out of the gates is that even though that was last year, our balance sheet is missing an equipment balance. And so we have to add, if you're just kind of making notes, we're going to have to add an equipment account and accumulated depreciation account for it, right? Because it should have been depreciated in 2017 as well as 2018. So there is a period or prior period accounting error that will be required to be adjusted through the retained earnings, and that's basically the 2017 depreciation expense and the 2017 repair and maintenance expense, right? That shouldn't have happened. It needs to be reversed. In addition, right, because the books are still open, there's current year depreciation that needs to be recorded, right? And because the original transaction was in exchange for common shares, there actually is no error associated with that. That was good. So before proceeding any further, you also want to figure out what the annual depreciation should be. So cost minus residual value divided by life is basically 150,000 divided by 5 years. So there's 30,000 a year in depreciation that is missing. If you like to keep track in each year what did happen or should have happened, so what they did is they expensed 150,000. That was the repair and maintenance error, but they only should have expensed depreciation of 30. And so as a result, the combination is that the expenses are too high by 120,000, resulting in net income being too low. So this is too high, this is too low, and of course retained earnings are too low. And in 2018, they didn't do anything, so there should be a current year depreciation expense. And of course, the expenses are too low, and because the books are still open, we can fix any remaining portions here. So we like to break the adjustments for these prior period and current period errors up into two pieces. Let's deal with the prior period first. So PY is prior year, of course, and this is a 2018 adjustment, okay? Now, we can adjust, we have to set up an equipment account, right? Because the equipment should have been capitalized. And just because it should have been done in 2017 doesn't mean it can't be done in 2018. The only items that need to go to retained earnings are revenue and expense impacts, right? Income statement adjustments. Balance sheet adjustments can be made directly to their accounts. So we need to set up and debit equipment for 150,000. Then we need to credit accumulated depreciation, right, for the first 30,000 for 2017. Remember, this is the 2017 depreciation expense. And we need then to credit retained earnings for 120,000, which was the combined error or the combined errors of incorrectly debiting repair and maintenance expense and forgetting to debit amortization expense. So as we said here, the expenses are too high, right? So we need to reduce the expenses that have been closed to retained earnings. So we're going to credit retained earnings to bring it back up. Right, so credit retained earnings for 120,000, and that takes care of the 2017 year. Then I'll just change the pen color here. This is the current year, the 2018 adjustment. Right, because the books are still open, we pretend like nothing happened. We'll continue to debit depreciation expense for 30,000, credit accumulated depreciation for 30,000, and this year is all taken care of. Now, finally, in terms of balance sheet impacts, in 2017, now the original entry, right, impacted equity because what they did is they debited the expense instead of capitalizing it, right? So the common share part was correct, so there's no negative impact there. So the error only results in equity being too low because of the expenses. In addition, assets and equity are understated by that error as a result, right? Because the assets are too low and the equity is too low because of the combination of the overexpensed repair and maintenance, the missing equipment, the missing accumulated depreciation, and the missing depreciation expense. So as a result of those correcting entries, assets are increased, right? Increased by including the original cost and then offsetting the missing accumulated depreciation, right? So associated accumulated depreciation are also recognized, and then equity also increases by an equal amount. So that's pretty much it for this particular error and for EP 15.5. So this concludes the Chapter 15 error analysis video tutorial relating to shareholders' equity. I hope you found this useful.